How to legally pay no taxes at all. My name is Sherman, the CPA, and today I want to show you how to reduce your taxes to zero. I personally have had several years with six-figure tax bills, and I have religiously paid them just to continue hearing stories about how billionaires like Jeff Bezos, Elon Musk, and Donald Trump pay almost no taxes at all. I used to think that the things they were doing just did not apply to me. I was completely ignorant to tax planning and just turned my head away from it. But the more taxes I paid, the more curious I got. So curious that I literally spent the last several years studying the tax law, earning my CPA license, reading books like Tax-Free Wealth, and spending tens of thousands of dollars on programs to learn the strategies that I am about to give away to you today for free. And all I ask for in return is that you help this video reach more people like yourself by simply clicking the like button below and sharing this video with someone that you know. All right, so I am going to give you the answers here up front, and then I'm going to show you how to get there. Here are the 5 ways you can reduce your income taxes to zero. Number 1, earn no taxable income. Number 2, earn money that is not considered taxable income. Number 3, earn taxable income and use tax deductions to reduce your income. Number 4, earn income and use tax credits to reduce your income. And then number 5, offset your taxable income with taxable losses. There is one common denominator out of everything that I just said, and that is income. Your taxes are based on your income. So if you want to reduce your taxes, you need to first understand how the IRS defines income and then use legal strategies to reduce the amount of income that you report. I will help you understand this as I explain these tax reduction strategies. So let's go ahead and get into each one of them. Number 1, earning no taxable income. If you earn no income, then you will owe no taxes. But if you earn no income, you would also be broke, which is obviously not what we want. But this idea is a great building block to help you understand the following strategies we will discuss. So let's discuss income for just a second here. There are 3 main types of income in the eyes of the IRS. Number 1, ordinary income, which is money you earn by trading your time for money, such as working a job. Number 2, portfolio income, which is money you earn by selling assets like stocks, for example. And number 3, passive income, which is money you earn by investing your money into private equity like real estate rentals or a business that you do not actively participate in. Now, each of these types of income are taxed differently, with ordinary income being taxed the most. So if you want to reduce your taxes, earn tax-friendly income like portfolio or passive income, which are taxed at much lower rates. But if you want to pay zero taxes, then earn no taxable income at all. Now, I know that sounds counterintuitive here, but this next tax strategy will make this even more clear in the ones to follow. Number 2, earning money that is not considered taxable income. If you earn money that is not considered income, then it is tax-free. And yes, there are money equivalents that you can earn that are not considered income to you in the eyes of the IRS. Let me give you a few examples involving stocks and real estate debt just to illustrate this. So here is an example of how you can receive tax-free wealth in the form of stocks. Let's say you own a corporation or you are an employee at one and a part of your compensation involves being paid in stocks. Well, the transfer of stocks to you from the corporation itself is a non-taxable event. If you never sell those stocks, then you would never pay taxes. And if and when you do sell those stocks, you would pay a lower rate of capital gains taxes if you held the stocks for more than 1 year. We see this all the time from CEOs of big corporations. One year, Mark Zuckerberg literally paid himself $1 as his official salary from Facebook. And it is because he owns shares of Facebook. And as long as he does not sell those shares, then he would pay no taxes. In addition to being paid in stocks, You can also borrow money against your stocks instead of selling them to avoid a taxable event. For example, let's say your stock portfolio rose from $50,000 to $100,000 in value, and you need money but do not want to recognize a taxable event. Well, you could take out a portfolio loan against your stocks, meaning you are using your stocks as collateral for that loan, and tap into the cash that you need. You can also do the same exact thing with real estate. Here is an example of how you can receive tax-free wealth through real estate debt. Let's say you invest in a commercial real estate building, like an apartment, in which case you finance. And let's say over a few years, you raise the rents and therefore you receive more rental income. Well, as your rental income increases, the value of your entire property increases. And as the value increases, you can pull more money out of your property through refinancing. Since refinancing is a form of debt, which is not taxable, you are essentially receiving money tax-free from your property as a result of the increase in property value. We see people borrow against all types of assets, such as real estate and stocks, as you just saw. And there are even more ways to put more money in your pockets without it being considered income. But these are just a few ways to show you how you can earn money that is not considered taxable income. Now let's talk about ways to reduce your taxes when you are earning taxable income, which will typically apply to most of us. Number 3, earning taxable income and using tax deductions. When you earn taxable income, you have to pay taxes. But the tax code allows you to decrease your taxable income with tax deductions. And if you earn income as a business owner or an investor, then your tax deductions are endless. Here's why business owners and investors pay less taxes than average taxpayers. The average taxpayer earns their money through ordinary income from their job. And as we know, the money you receive from your job is taxed before it even touches your hands. Then you have to use the leftover money from your job to pay your bills. Whereas the opposite is the case for business owners and investors. They earn money from their business or investments, and it is not taxed before it touches their hands. They pay their bills before they pay their taxes. And then they can use the bills they paid as tax deductions to pay less taxes on their income when they file their taxes. And there is no limit to the amount of things you can deduct as a business owner or investor. So much so that I created an entire video on how they can write off almost anything. So make sure you subscribe to our channel and check this video out to learn more about this. Number 4, earning taxable income and using tax credits. The next way to reduce your taxes is through the use of tax credits. Unlike tax deductions, tax credits do not actually reduce your taxable income. Instead, it directly reduces the amount of taxes you owe, which makes this even better than tax deductions. Tax credits are basically free money paid to you from the government for performing certain actions or fitting certain criteria. This is how the government influences taxpayers, by giving them money through tax incentives to do the things that they believe are important. And if you do these things, then you can save a significant amount of money in taxes. For example, one of our businesses received over $100,000 in tax credits simply based on our business address. We located our business in what is referred to as an opportunity zone, which is basically an area that the government wants to invest in order to create more jobs. We received thousands of dollars in tax credits for each job we created in that opportunity zone, which resulted in significant tax savings. And there are plenty of tax credits out there. Some big ones right now are the research and development tax credits and work opportunity tax credits. Number 5, offset taxable income with taxable losses. Another way to pay zero taxes is to offset income you earn with losses. If you own a business or an investment that produces a loss, then you can use that loss to offset other business income or investment income. Now, of course, you don't want to spend $1 to save 15 cents on taxes, and I'm not suggesting that you go out there and try to lose money. But what I want you to know is that there are ways to create tax losses without actually losing money at all. Here are some ways you can create tax losses without actually losing money in the long term. Number one, tax loss harvesting for stocks, which involves selling losing stocks in your portfolio to create a tax loss and using the proceeds to invest in other stocks that appreciates in value later. Number two, depreciation, which involves depreciating assets you own, which is a tax deductible expense that costs you nothing, by the way, and can create a loss on your tax return. Number three, business investments, which involves accelerating expenses in your business today to increase the value of your company in the future. If you want to learn more about any of these tactics or strategies that I mentioned today, make sure you check out my description for more information and drop a comment below with any questions you have. And also make sure you subscribe to our channel to learn even more ways you can save on your taxes and increase your wealth.